All right, recession watch. The recessions that come in here at the Presidio Perspective. We want to make sure that you are in the know and prepared for what's to come. Dave, C, and I here. David on the ones and twos. We're glad you could join us. Let's get it going. All right, Dave. I said it. We've said it once. We'll say it again.
You made the call.
The recessions are coming, right? The recessions are coming. So I think, both of us think it's really important that we continue talking about this, and then in lots of our podcasts, we do make sure investors are focused on the long term because that's how you are successful at investing. However, we are still seeing people way overexposed to risk assets, investing in the wrong stuff with their head in the sand, pretending like this, 747 is going to land on an aircraft carrier and that we're not going to go into a recession. And it's just completely wrong. And people need to be aware of that now before the event occurs. You can still do things in your portfolio. But I think we need to ring the alarm and make sure that people know.
We've had a nice bounce from the lows in October, but doesn't necessarily mean that the pain is totally behind us.
No, it's all in front. Absolutely. Not all. We've had some pain, but there's more to come. And again, we're talking about short term. So I think it's important, this is market commentary we're having. These are just things that we see. But, something that we always talk about in financial plans is it's just math. And there's a lot of things going in the economy, in the stock market and real estate market that's just math too. And it's kind of undeniable, not really opinions. We can just talk about some of the facts and then what happens, to risk assets, asset classes during these market cycles, right? One of your 3 principles of investing that you shared on a previous podcast is that markets do have cycles. Right, something to understand. So we want to know, where are we positioned in our portfolio? Another principle that you have, which I think is great, is know what you own and why you own it. Again, I am meeting after meeting these folks that I meet for the first time. It's kind of like my job here at the firm, right? And I'm meeting these folks and they don't know what they own or why they own it. A conservative couple, conservative investor with plenty of money has 70% of their portfolio allocated to stocks, going into this market with big real estate holdings. And it's just, their wealth manager had them, big company had them fill out a risk tolerance questionnaire or something like that and put them in a model. There's no discussion going on about what's happening right now in the economy, what changes need to occur. So anyway, it's a good time to assess the situation, I think.
Always is.
Yeah. Well, maybe not always. There's better times to assess, right? So, the market goes down another 25% and you can assess then, right? Or you can assess now and say, what can I do today to prepare for that? And then what am I going to do, if that event occurs?
Love the principle we talked about last week of know what you own and why you own it. If this is long-term money that we're talking about, then maybe that's not the worst thing in the world, because I think we both agree that close your eyes and look 3 years, 5 years down the line, and things look better.
Better, yeah.
But in the money that you need in the short term, where you're not comfortable taking some of the volatility that we're very likely to see in the coming months and maybe year and a half, let's think about a different tactic.
Yeah. Yeah, so you kind of mentioned 2 things. There's capacity for risk, meaning do you need the money soon? And the timeline, we don't know. We like to say, I'd like to look at the next 5 to 7 years of conservative cash flow, really. You give a whole market cycle,
Yep.
Right? Because they could look lower for longer, all kinds of different recessions, right? There's U's, there's V's, there's W's. No one's expecting a V this time around, so we'll see what happens. But being prepared, right, is definitely going to help you. And then your tolerance for risk. So just because you don't need the money in 5 years doesn't mean that you're okay watching it go down by 20% from here. That might be too much. And you might not need to be investing for growth. Like, why are you taking all this risk with your money, right? I mean, we need to stay ahead of inflation, but there's other asset classes other than risk assets that we'll talk about today. I'm going to keep my eye on the clock today to Okay. So, market cycles and asset classes, right? So you say markets have cycles, and so if we kind of review, you have the contraction market cycle, right? Where you're going into that recession, you're finding the bottom, okay? And so, like March of 2009 was kind of the pit of the great financial crisis when stocks started recovering. Now, layoffs were still at its heaviest points at that point. They had yet to really materialize. Foreclosures came year after. Real estate didn't bottom for another 2 to 4 years, depending on where you were, in the country.
Mm-hmm.
So you think of 07, 08, the bad news happening, and then you think of, when the market finds a bottom, like the stock market. Then you think of when the actual recession hits a bottom, which is usually 2 or 3 years later, depending on, there's technically a recession in COVID, which looked a lot different, right?
Mm-hmm.
And so then just knowing that so you come out of that, and then you hit what's called the recovery period, right? Where things have gotten so cheap, right? And everyone has run for the door, they've thrown in the towel, and things are so scary that no one's willing to invest in risk assets, and that is typically the best time to buy. What's the Warren Buffett line?
When there's blood in the streets.
Yeah, something like that, right? And that's, and so that's when you want to go and buy. That's when you want to make the investments. But it's easy. So you have the recovery, sometimes really quick, and then you have this longer kind of questionable expansion period. And so kind of just think of the last decade, and you kind of saw all those market cycles. I guess it's more than a decade.
So maybe it's helpful to take a look at where we are today and what that math looks like.
In the final phase, right, is the contraction.
Right.
And that's where we are today.
Right.
Yeah. So, walk us through the math.
So just to take a bit of a longer term view, if we look back to the fourth quarter of last year, markets bottomed in October 12th, markets bottomed, and coincided with the peak in interest rates. Right, if we think about the inflation narrative through last year, we hit over 9% inflation in the summer. Inflation started to peak. Markets became a little bit more optimistic that the worst was behind us. You saw a peak in the 10-year U.S. Treasury yield, the 2-year U.S. Treasury yield, and equity markets loved that. We went from 3,500 on the S&P to flirting with right around 4,000 today. But we've now seen really stronger economic data, which makes the market think that inflation isn't as behind us as they had hoped. So we've seen rates pick up again.
So that's what? Unemployment numbers and
retail sales numbers, unemployment numbers.
Yeah.
We saw a couple of really positive months of inflation, right? We saw the month in January where inflation fell on a month-over-month basis. But the most recent numbers, we've seen it pick up again. We've seen PPI pick up. We've seen the CPI numbers pick up, the PCE numbers pick up. And I think the Fed's really focused on jobs, right? What does the labor market tell us? When unemployment is at 3%, almost the lowest it's been in 40 years. Don't think that this is the point in time where Jay Powell and the Fed is ready to say, job done,
it's behind us. Yeah. No, not even close.
Yeah.
Not even close. And, we've a mantra that you've heard over the last 10, 15 years is don't fight the Fed, right? It's expanded multiple Fed chairs. The Fed, if you look at interest rates and you look at the yield curve, and you look over time, it's pretty scientific, right, of what happens in these different market cycles. And it can tell you something as investors that you don't want to really fight that phenomenon, And I mean, Powell even talks about it, that they have these blunt, crude instruments to try to, help the economy along through these different phases of a market cycle. And they're blunt and they're crude, right? They're not surgical equipment. They're in surgery with like a chisel and a axe and a hammer.
And they admit that they're making decisions that affect the future economy based on past data.
Correct. Right. Absolutely. And they also say with these blunt tools and instruments they're using that they're going to cause some damage. And they always do. They always do. And that's what we're talking about right now. We are talking about we are in the contraction phase of a market cycle. We are not in the expansion phase. So there's different asset classes that do well, and there's ones that don't. And risk assets typically don't do as well during these cycles. In fact, they have a lot of downside risk. And so we're talking about stocks, we're talking about real estate, we're talking about things that don't make money. Okay, and that you can't hold. I like what you say. If things that if you drop it on your shoe or something and say ouch, something like that, right? The tangibles do better. If you look at here's the asset class returns last year. Commodities were up 13.5%. Cash did 5%. Stocks were down 13%, and S&P was down 18%. What market? Is there anybody that that is under 50 that has ever seen that phenomenon in their entire life? Like, I know I haven't. I've studied it as you have, right? But you have to go back a long time, to even be alive during a period of time that was like that.
Yeah.
So markets have cycles. So we know that this happens. And so now when they're using these blunt tools and instruments, so if you look at what that 2-year over 10-year kind of yield curve. And you just layer that back going over the last, 50 years, and you can just see every time it just reaches this inversion point, where you're making more money loaning for 2 years than you are 10, right? That doesn't make sense in investing. What is that saying about the economy? And every time that happens, we essentially get into a recession.
Right. That's the bond market pricing in the recession, right? The bond market saying that the Federal Reserve will need to start cutting rates sometime in that period. So the average rate that you'll get over the next 10 years is less than the average rate you'll get over the next 2 years.
Yeah. So right now you get what you loan it out in the next 3 months, and you get 5%, right? 3 months. So we love that because we're at the banks and we're making our money market accounts and we're getting 4 or 5%, and it feels really good. But that's going to change really quick. We're getting that now, right? It's on the sidelines, and we'll get to that in a second. But on the long term, you're lending out for 4, and people I don't want to loan for 10 years and get 4. I can loan for 3 months and get 5. It's like, yeah, well, you're not going to be able to lock that in for 10 years. And that's also saying, what about the growth in the economy over the next 10 years?
Right.
Not a lot of bullishness there.
Right.
It should tell you something about your stock side of your portfolio.
Right.
So there's a lot that we can learn from this, and so this is where we have these different asset classes. The downside, we know real estate's coming down and it's got a lot further to go. We do have, it's not 2008. It's not like an overbuild. There's a lack of supply, so that's going to look a little different. But, the Fed's using these instruments. 30-year mortgages hit 7% again yesterday. I saw a headline. Who can afford the home when you've doubled, tripled, in some cases, the cost of interest? The house is going to have to come down.
Right.
And, housing, you look at stocks and we look at that PE ratio, what does the rent to price of a house today look like?
Pretty expensive.
Isn't it like just as expensive as it's been over time?
Yeah.
So like this is like buying tech stocks, right, at the end of 2021, right? When the valuations are so high, right? You're like, wow, what is that going to do typically to the price? And we're looking at these phenomenon in real estate. So, what should we expect as investors for that, as for the, residential real estate prices?
Yeah. I think you nailed it. Right. Real estate largely is a function of interest rates. As interest rates are very low, you can buy more of a home. Yeah. You can spend more on the same home. Yeah. As interest rates rise, costs more to service that debt. The amount that you're willing to pay for that home isn't quite as high as it was. I think the flip side of it, though, is it's not only a demand issue, but it's a supply issue as well. What have we seen from home builders recently? The new home starts are much lower than they were. Homes going under contract are much lower than they were.
Right.
You're seeing the decrease on the supply side as well. So think that we're talking about Right, you said it, this isn't 07, 08, where we're going to have this massive default cycle. But should home prices come down 5%, 10%, 15%? I think that's pretty reasonable.
Absolutely. I mean, you still have during contraction periods, and then, certainly during the bottoming out of the recession, you have a lot more unemployment and layoffs. That's going to cause homes to go on the market and sell, and at lower prices because people can afford less. So there's just a holding period before that kind of has to break and go down. So, and then equities. I mean, this stock market seems pretty fully priced, right? Like, what is this? What are we pricing in as an earnings per share right now on the S&P 500?
So right now we're at about 18 forward earnings per share. So
18 is the multiple.
18 is the multiple.
On what earnings?
That's the important point, right? We're looking at about $220 in S&P 500 EPS for 2023, which is much better than it was. That's down about 13% from where it was over the summer.
And so Dave says that's better because it's lower, and so that doesn't mean it's better. That means they're less profitable, but at least that the market's a little more rational about the fact that we're going into a recession.
We've already brought down those earnings expectations some.
Or companies have, yeah.
I think the concern that we see when we look at the numbers is there more pain to come? Will earnings expectations continue to fall from here? Which I think there's a very real possibility that they will. And looking at a multiple of 18, that's right in line with the long-term average.
That's a long-term average. Yep. Okay, that's the average. So you're looking at a multiple. And then, when we just sit back, again, we say it on this podcast all the time. What are the shoulda, woulda, couldas I'm going to be saying to myself a year from now, looking back at this moment? And did I stand here and say, I'm going to pretend like higher borrowing costs don't eat into corporate profits. I'm going to pretend like massive government spending during COVID doesn't increase future taxation. I'm going to pretend that higher mortgage rates 2 to 3 times what they were aren't going to bring down the cost of housing and the price of housing. It's like, what are we talking about? I'm going to pretend like this inverted yield curve isn't leading indicator to that we are going into a recession. I'm going to pretend like locking in 4% over the next 10 years isn't as good as locking 5% over the next 3 months. I mean, these are all the things that the people are saying with their portfolios, and we see it. They're missing it, right? We don't want to miss it. We want to look at this data. It's just data, and look at it. And again, we're not saying that you get out of the stock market, because that's how you can get really, really poor. But have a mathematical approach to your asset allocation, and don't have 70% of your money in equities when you only need 40. And there is massive opportunity when you look at these kind of market cycles of where you want to be. So it's also what type of companies you want to invest in. And so talk to me about that. What are we seeing right now? What did we see last year, and what are we seeing right now with the, divergence of different asset classes in the stock market?
That's exactly right. I think we've preached the importance of being different here for a long time, for not just owning the S&P 500.
Another one of your principles. Good plug. Be different, right?
That's what I'm here for.
Yeah.
Right. Even still, you're buying a pretty large allocation to large cap tech when you buy an S&P 500 market cap weighted ETF. I think the point that we're making here is there's a lot of risk in that type of allocation. Where we see more opportunities are the segments of the market that are trading at more attractive valuations, where the earnings have already been adjusted downward, where there's strong balance sheets, where you as an investor are getting paid dividends.
Yeah.
So think that there are areas of opportunity here in the market, but not by buying the largest names.
Absolutely. And they talk about rebalancing a portfolio, repositioning, being different, meaning don't use what worked last time, right? If you look at 2019 to 2021, right, during that kind of bull market trade, the top 3 performing sectors: information technology, consumer discretionary, communication services. This is the expansion part of the economy. This is when we're finding the top, right? Valuations get really, really stretched. Okay, we're now in the contraction phase. And the bottom three sectors from 2022 to 2023 up until the end of February is consumer services, consumer discretionary, information technology. Essentially, if you take the three things that work the best and then got out of those, you far outperformed, right?
Value is down 5% last year?
Down 2, S&P down 15, and growth down 27. If you went through the expansion phase 2019 to 2021 of that market cycle and you looked at the best performers, okay, those were the worst performers during that time: energy, utilities, consumer staples. What has been the best performers since 2022? Energy, utilities, consumer staples, right? So these are really important things to understand about market cycles. So when we're talking about the risk in the stock market, we don't mean you go to cash. We don't mean that you exit out completely, but know what you own and why you own it.
Yeah.
And let's not pretend like we don't have massive inflation, that we're not in a contraction period of a market cycle headed into recession. Heading into recession, right? And what's going to happen and where we want to be positioned. And, we have our eye on the horizon for the long term, okay? And then, but where is the opportunity? So tell me about, let's focus on fixed income too a little bit, not just about the different sectors of the S&P and, the weakening there, but, we're preparing for another 20% downside potential, right? That's when you look at the data, if you just take the S&P, okay, and if you just look at that, and you there's a pretty easy baseline case for watching a 20% drop from here, I would say. Is that not too crazy?
Not at all. And historically, that's not abnormal.
Yeah.
What do statistics tell us? That once every 2 years, we see a 20% drop in the S&P 500?
Yeah.
So,
I think, yeah. So a lot of people are calling that last year, right? So we're not saying we finished the year there. We're not saying it happens this year. We're saying sometime during this market cycle, right, of where we are, you're going to see volatility. You can see another steep sell-off. Okay, so be prepared for it. It's just part of market cycles. Okay, you don't want to get too cute. It's not a guarantee, right? So we stay long-term focused, but we are prepared for that. And then where do you want to position the rest of your portfolio? Again, people have been investing in growth and cash forever out of fixed income, and they're still doing it because cash is paying you 4 or 5%. But you're going to miss it because if we do hit that contraction period, and I mean, we talk about this yield curve all the time, and I know you're doing some webinars for our clients and their friends coming up in April. So this is going to be really valuable. We're going to get into the nitty gritty on our portfolios for our clients there. But, for our listeners here, that yield curve, that front end goes up, and when we go into that recession, that all comes down. It all comes crashing down. The front end comes crashing down. The long end comes down too. And when interest rates go down, the price goes up, but not on a 3-month loan, on a 10-year loan, on a 30-year loan. That's where you're going to see the bump in the value of interest rates go down, right?
Yeah, exactly. And I think you alluded to it before, but as an investor, I would much rather lock in 4% for the next 10 years than 5% for the next 3 months, 6 months, and then 6 months from now have to then accept market rates, which might then be significantly lower as the Fed cuts rates to fight the recession.
Yeah, so the front end's now 0 and the long end's 2. And so, now I don't want to get 0, I want to get 2. Right. Well, if you just were a little bit forward thinking, you'd have locked in 4. And that 4, by the way, has a big bump up in value now because it's marked to a 2% market.
Right.
So it's going to provide that ballast. If we do hit that 20% drawdown, your fixed income is helping you there, value average. And what do we want to do? We want to buy low, sell high. You should have a pretty good opportunity there. If you do your asset allocation right and you don't get too cute, use duration assets to offset risk in your equities. And when you have that spike at that recession, March of 2009, and those different times in 2011 and 2015, we've seen these things happen before, okay, many, many times, you'd be able to bring that asset allocation back in line, selling what's worked, buying what hasn't. Gosh, if you did that during the last market cycle, you killed it, right? Energy's up 70% since the beginning of last year. no one had energy in the portfolio.
After being the worst performing sector for the last decade?
Right.
For how long?
Yeah, and you know, when you go into a recession, commodity prices fall. Okay, so now if you keep chasing the trade, you got to know the next part of this is the contraction. So we're in the slowdown, then you hit that contraction, and everything becomes worth less, price-wise. It's not inflation anymore. We're fighting the other way because the prices come down. We beat inflation. Now we got to try to stimulate the economy. These are just market cycles. Got to know what's happening, right? And we have to look at the stuff that's right in front of our face today and say, are we going to look at ourselves a year from now and go, what the heck were we thinking? Like, don't. Assess your risk. Assess how much money you have in the stock market, how much money you have in real estate. What decisions are you considering? Do you know what you own, why you own it, where you're positioned? Are you still in the stuff that was working during an expansion period, not the contraction period? Have you admitted to yourself that we're going into a recession and that it's going to happen? Are you prepared to weather the storm? Do you have non-risk assets? And then you have some cash, right? You say it's not so bad, right? What are we getting? Having a little on the sidelines.
Yeah, high 4s, 4.6, 4.7 on your cash.
So hiding out there, picking your spots, right? For, again, not being too cute, but
makes it possible to wait for a better entry point.
See, and this is the other thing that you and I know because we go to these classes and we talk to people live, and I'm teaching these classes and I'm still getting blank stares when I talk about the perfect investment and we talk about stocks, bonds, real estate, and cash and creating a portfolio diversified to get you growth, safety, and liquidity, right? And then I say, well, what are you earning on cash today? And everyone goes, nothing. Because that's what they've said for the last 15 years. They go, nothing. I go, no, you're earning actually quite a bit. Like you said, 4 to 5%. When people figure that out, how many people are going to keep investing in syndicated real estate deals? Mm-hmm. How many people are going to keep buying growth stocks that don't make money? Mm-hmm. How many people are going to just keep buying stocks in general or long duration bonds because they're just it's sucking all of the money out of the system, And so all of those rates are going to make us stop buying stuff. I'm not going to spend my money as much because I get a 5% return to not spend. I'm incentivized to save. I'm disincentivized to buy risk assets. Cost of borrowing means I can't afford less. It means companies make less money. What are we talking about? These are just facts. What's going to happen? So let's just be mindful of what's happening right now in this market cycle. And how do we want to play it? So get your playbook together.
It's a different cycle.
Yeah, absolutely. All right. Well, we're ringing the alarm today. We'll be back. Really looking forward to your webinars, man, coming up. So we'll send our clients more information on that. If you want to find out information, get in touch. But you have a really good insight on what's going on in this market and how to play it. So we're looking forward to it.
Good.
Awesome. All right. Thank you, everybody. So little doom and gloom today. But in the long term, markets go higher. In the short term, they can go lower. We want to be prepared for that and get a plan. Okay, so your financial plan, it's math. You should be fine over the long run so long as you do it. But it's a good time to assess the situation right now. And if you haven't made change in your portfolio since the new market cycle started, this is your warning call. I love this goat. All right, guys, have a good one. Thanks for tuning in. We'll see you next time at the Presidio Perspective.